Hello! Today we're going to be discussing the effective interest method for bonds payable. The problem says, on January 1st, 2011, Chewy's Pet Grooming issued $500,000 of 10% two-year bonds. The bonds pay interest semi-annually on June 30 and December 31st. The market rate of interest on the date of issuance was 12%. The bonds were sold at a price of $482,678. Part 1 asks us to prepare an amortization table using the effective interest rate method for these bonds. And over here on the left we have the table that we'll be filling out throughout this video. So the first thing to note is that these bonds are going to last for 2 years and they pay interest semi-annually, meaning twice a year. And that's why we have 4 different periods over here for the 4 different interest payments. Now we also have a period for the issuance of the bond, which isn't going to have any value for the first 3 columns, but it might be helpful to fill out the balance of the discount and the carrying value to build off for the future rows. So first, the balance of the discount. That's going to be the difference between the par value and the selling price. So we take the par value of $500,000 and we subtract the issuance price of $482,678, and that gives us an initial balance of the discount of $17,322. The carrying value will start at whatever the selling price is. So that is $482,678. The next thing we can do is calculate our interest payment for our interest paid column. The way we can do that is by taking the par value of $500,000, multiplying by the 10% contract rate, which is listed with the par value, and then dividing by 2, since these bonds pay interest semi-annually. And when we do that, we see that the interest payment is $25,000. And that's going to be the same number for each of the periods. The next thing I want to do is to find the market rate of interest divided by 2. Once again, dividing by 2 because these bonds pay interest semi-annually. So if we look closer, we see that the market rate of interest on the date of issuance was 12%. So if we take 12% and we divide by 2, we'll get a 6% market rate of interest divided by 2. So everything we've done so far I consider the setup for the amortization table. Now let's move on to the other columns. So first, the interest expense. Now you might be wondering, why should the interest expense be any different than the interest paid? And that's a question I want to explore right now. So let's look at this graphic that I created when we calculated the price of the bond. So you'll notice that the company is borrowing $482,678. They have to pay interest payments every 6 months of $25,000, and then the principal repayment of $500,000 at the end of the bond's life. Now I view the interest expense as coming from 2 different sources. One from each of these interest payments of $25,000, and then 2 from the difference between the selling price and the principal repayment at the end of the bond's life. So if you think about this, the company is borrowing $482,678, yet they actually have to pay back more than that, $500,000 at the end of the bond's life. So that's an additional form of interest expense, and the amount happens to be the same as the discount, which is $17,322. So the discount of the bonds actually ends up being an additional form of interest expense. Now what the company usually ends up doing is they deal with this in one of 2 ways. One, they can allocate this interest expense equally to each of the different interest payments, and that would be called the straight line method. Another method, which we're going to be doing in this video, is called the effective interest method, and you'll see how that works as we complete the rest of this amortization table. So if you look at our chart, you'll see that I have the formula to calculate each value at the top. And the letters refer to each of these different columns, so A, B, C, D, and E. So first, for the interest expense, we need to take E, previous, so that means go up 1 for the previous, and then find column E. So it's this number multiplied by the market rate divided by 2, which is 6%. So when we multiply those 2 numbers together, we get the interest expense of $28,961. Next, we can calculate the discount amortization by taking B minus A. So that's the interest expense minus the interest paid, which gives us $3,961. And now just note, if you had a premium instead of a discount, then you'd have to actually take A minus B, so the interest paid minus the interest expense. Next, we can find the balance of the discount by taking the previous balance, D previous, and then subtracting C, which is the discount amortization. Next, we can find the carrying value by taking the previous value for the carrying value and adding that to C, which is the discount amortization. Now, if you were to have a premium, then you'd actually have to subtract the premium amortization. And I just want to note there's one other way that you could find the carrying value, and that's by taking the par value, which is 500,000, and subtracting the balance of the discount. So 500,000 minus 13,361 would also give you the same number here. And you might be wondering, well, what if I had a premium? Well, then you could take the par value and you'd have to add the balance of the premium. So a lot of these signs kind of get switched around if you did have a premium. So now that we've finished our first complete row of the table, let's talk a little bit about what each of these columns mean. So the interest paid is kind of self-explanatory. It's just the amount that the company is paying out in interest for each period. The interest expense, as we talked about earlier, stems from two different places. One from the interest paid, and two from some portion of the discount. So the balance of the discount started at 17,322, and we said we were going to have to allocate that to each of the 4 periods, because this is an additional interest expense that the company has. So the first period, 6/30/2011, is going to have $3,961 of additional interest expense. So that's how much we're going to take out of the discount. So the new balance of the discount was, when we subtracted these two numbers, 13,361. So we have to allocate this amount to the remaining 3 periods, to where it will eventually get back down to 0. And finally, the carrying value is really nothing more than just the par value minus whatever the discount is. It can also be thought of as a book value for the bond as of some particular date. And one thing you might want to note here is that the balance of the discount should be decreasing and decreasing until it eventually gets down to 0 at the end of the bond's life. Whereas the carrying value, if you have a discount, is going to be increasing and increasing and increasing until you get to the par value, which is $500,000. Now, if you had a premium, it would be a little bit different. You'd have a value here which would be higher than 500,000, let's say 520,000, and then it would be decreasing, decreasing, decreasing until it got to $500,000. So the key is your discount is going to be approaching 0, and your carrying value is going to be approaching $500,000. So the rest of the table ends up being a little bit more repetitive, which is kind of a good thing. It's just going to be the same formulas we're going to apply to the remaining rows. So here for the interest expense, we have to take the previous carrying value, which is over here. We need to multiply that by the market rate of interest divided by 2, which is 6%. For the discount amortization, we take B minus A, which is interest expense, minus the interest paid. For the balance of the discount, we take the previous value and we subtract the discount amortization. For the carrying value, we take the previous amount and we add the discount amortization. And then you can do the same thing for the remaining 2 rows. So maybe I'll give you a moment right now to maybe pause the video and see if you can come up with the values for the last 2 rows of this table. So we're back here with the last 2 rows filled out. So if you've done this yourself, take a moment now to compare the numbers that you've created and see if they match the ones that I have here. Now you might be noticing that the balance of the discount came to -4 when it should be 0, and the carrying value is 500,004 when it should be 500,000. And the reason why we got off a little bit is due to rounding, actually, in the calculation of the price. So these are going out more than the decimals you see here. These are only going to the nearest dollar. But in all the calculations, it's keeping the additional decimals. So if you're doing this on your own, you may have been a little bit more or less off than 4. In my case, I'm off by $4. So what you can do to correct this is just go to your interest expense and subtract 4. So we take the number here. If we subtract 4, we'll get 29,713. And then when you calculate the remaining columns, you should get 0 for your discount and 500,000 for your carrying value. Alright, now that we have completed the table, we are ready to move on to step 2, which is to record the journal entry for the second interest payment. So the second interest payment is going to be based on this row right here, and we're going to use the table in order to complete that journal entry. So I have some journal paper hiding here, And we're going to use the first three columns of this table in order to help us complete this journal entry. So first we have the interest paid, which is $25,000. We have the interest expense, which is $29,198, and the discount amortization of $4,198. We're going to be using these three numbers in our journal entry. So first, I know that interest expense is an expense, so therefore it's going to have to be a debit in my journal entry since expenses increase with a debit. So we're going to have interest expense for $29,198. Next, I know that if I have a payment, that's going to have to involve cash. And when cash is paid, that's going to have to be a credit to cash. So since I am not sure about the other account yet, I'm just going to leave a space, and I'm going to credit cash for $25,000. Now it seems clear that the difference here, which is the $4,198, must go on the credit side. And the title of that account is going to be Discount on Bonds Payable. So there's one final part, which is part 3 here, which says assume that the bonds are retired prior to maturity on December 31st, 2011 at a call price of 102. We need to prepare the journal entry to record the retirement of these bonds. So when you're calling a bond, that just means we're going to pay them off early. So instead of waiting until the end of the bond's life after 2 years to retire them, well, we're going to do that early on December 31st, 2011, which happens to be the same period we were doing the interest payment for previously. So something to note here is that they were called at a price of 102. So that means 102% of par value. And if we scroll up, we see that the par value was $500,000. So to find the call price, we take $500,000 and we multiply that by 1.02, which is 102%. And if we do that, we get $510,000 for our call price. So I know in my journal entry, the company is going to be paying out $510,000. So that's going to have to be a credit to cash for $510,000. And I already know there's going to be 4 accounts, so that's why I've left some space here and put the cash as the credit in the final position. Now next you're going to want to pay attention to some of the different amounts in that row. So since they were retired on 12/31/2011, we have to get rid of the balance of this discount right here, which is $9,163. And something to try to keep in mind here is that the balance of the discount always has a normal debit balance. If you had a premium, it would be a normal credit balance. So if we want to close this out and it has a debit balance, we have to credit this amount. So we're going to credit the discount on bonds payable for $9,163. Next, we know that we initially were supposed to pay out $500,000 at the end of the bond's life, and that's represented by the account called bonds payable. So we have to close that account out as well. So we need to put bonds payable, which is a liability, so we're decreasing that when we debit it for $500,000. Finally, we're going to have the difference here. If we take the sum of the credits and we subtract the debit, we'll see that we have a $19,163 that we still need to balance this journal entry. And the name of that account is going to be Loss on Retirement of Bonds. Now, why is this a loss, you might ask? Well, if you had to make up the difference on the credit side, then this would have been a gain, but we needed more on the debit side, right, in order to balance out this journal entry. But thinking about this a little bit more closely, we know that we were initially supposed to pay out $500,000. Well, now we're actually ending up paying out more, $510,000. So you can already think of that as kind of a $10,000 additional expense. Now, we also were saying earlier that the discount on the bonds payable acts as an addition to our interest expense. So this is going to be $9,163. That was initially going to be recorded as interest expense if we did the rest of the bond's interest payments. But since we're not doing those interest payments, this is going to get absorbed in our loss on the retirement of bonds.